Thank you for joining us for today's edition of MarketPulse presented by Lodestar Advisory Group. My name is George Corrali and I'm the Managing Director here at Lodestar. We are a fee-only registered investment advisor specializing in actively managed ETF, mutual fund, and closed-end fund portfolios. I'm a certified financial planner and member of the National Association of Personal Financial Advisors, otherwise known as NAPFA. NAPFA is the premier fee-only financial planning organization in the nation, and its membership standards are the highest in the industry. We recorded this presentation after the close of the market on Monday, January 25th, 2016. So what we're going to do here today is walk you through a few charts, but first I want to talk to you about some obligatory disclosure information. You should not construe anything we talk about here as a recommendation to buy, sell, or hold any security. You should always do your own research to determine whether the securities we talk about are appropriate for your portfolio. As you know, investing involves the risk of loss, and investment should always be made based on your specific needs and objectives, goals, time horizon, and risk tolerance. Lodestar's clients may own securities mentioned in this presentation. All charts and other statistical data were obtained from sources which we believe to be reliable, but we do not represent that they are accurate or complete. And finally, all opinions expressed and data provided are subject to change without notice. So let's jump right in. Here's a chart of the S&P 500 that goes back a few days, and it illustrates the fact that on January 20th, we were down about 12% from the record close of the stock market that occurred on May 21st of last year. We've rallied since then, but we're still down about a little over 8% for 2016. Look, the stock market got off to its worst start in history this year, no doubt creating a great deal of angst for most investors. But, rather than focusing on the turbulence, wondering if you need to do something now or what the market may do tomorrow, it makes more sense to focus on developing and maintaining a sound investing strategy. Following a solid plan designed for a period of increased volatility will likely allow you to effectively curb anxiety and its deleterious effects on investment decision-making. So here's an effective 6-point investing game plan for a likely more volatile 2016. Number 1, have moderate equity exposure to stocks. You should always own stocks, but the key this year is to scale back exposure when stocks rally hard and increase exposure when they're getting beaten up. Generally, portfolio stock exposure should be below the upper limit of your potential equity range. Number 2, emphasize liquidity throughout your portfolio. Invest only in liquid securities, assets that can be converted to cash quickly and with minimal impact to the price you're going to receive. Do not purchase investments that lock your money up for years or require a substantial cost to exit. If news turns decidedly unfavorable in any particular asset class, you need to have an exit. Non-publicly traded real estate investment trusts, for example, which have been sold to thousands of investors, would fit the definition of an illiquid security. Number 3, own the right kinds of funds. This is no time to own funds based on broad-based stock indexes. If we're in a bear market and the stock market eventually goes down by 25 or 30% or even more, your index funds are going to perform similarly. And if the slow growth environment we're in right now turns into a no growth environment, every economic sector will turn intensely competitive. The weak players, which are included in index funds, will lose market share and profit margins will shrink, sending share prices of those companies disproportionately lower. A low volatility fund would be one example of the right kind of fund to own. Number 4, utilize tactical strategies. Include a few specialized funds in your asset mix, which are designed to be productive in weak markets. Examples would be market neutral funds, long-short funds, and dividend-focused funds. Many of these types of funds are outperforming the broader stock market indices this year. Number 5, consider precious metals. Although metals have been out of favor for quite some time, the economic woes sparking turmoil for global equities have been a boon for the precious metal sector, as investors pile into safe haven assets. This sector has historically attracted frightened capital from around the world when headlines feature terrorism, armed conflicts, currency wars, or even deflation. Exchange-traded funds are a cost-effective way to add precious metals to your portfolio. Just remember that this sector should only represent a small percentage of your overall portfolio. And lastly, number 6, be strategic when purchasing bonds. Bonds are the classic defensive investment when stocks skid, but the tricky aspect of today's global bond market is that central bankers have suppressed interest rates dramatically. In fact, Europe and Japan now have negative interest rates. So you need to be strategic when purchasing bonds and/or bond funds in your portfolio. High-yield bond funds will be pressured on further stock market weakness and should largely be avoided. And you also need to be cognizant of the yield on the 10-year Treasury bond before making any bond purchases. Just a few months ago, it sat at 2.50%, and today the 10-year is at 1.70% or so. So now would not be an ideal time to add bonds to your portfolio, but if rates were to head higher again, back to 250 or 275, that would be a pretty good time to consider additional bond purchases in your portfolio. So to summarize our 6-point investment game plan for 2016, number 1, have moderate exposure to stocks. Number 2, emphasize liquidity throughout your portfolio. Number 3, own the right kinds of funds. Number 4, utilize tactical strategies. Number 5, consider precious metals. And number 6, be strategic when purchasing bonds. You know, nothing causes investors to question their strategy and worry about their money like dramatic moves in the markets. Instead of making poor decisions during a big panic decline, just say no. Market volatility often leads to outstanding investment opportunities. Sometimes we're our own worst enemy. The human mind is built to be anxious about the unknown. By following a sound investment strategy, you'll be better equipped to ride the ups and downs of the market without making impulsive decisions that wind up hurting portfolio performance. So that wraps up our presentation for today. Lastly, I just want to mention that we provide MarketPulse presentations on a periodic basis, but we are speaking with clients and prospective clients here in our office in Short Hills, New Jersey, all the time. We offer a free portfolio review. We'll go over your goals and objectives, provide a professional second opinion with respect to every position in your portfolio, and discuss some different strategies that you may be able to implement to achieve your goals. You can call us at 973-218-2440 to schedule that. You can also send us an email. The general email for the company is info@ldstar.com. My personal email is gcorrali@ldstar.com, so you can email me directly if you'd like, and I'll be more than happy to answer any questions you may have. Our website address is www.ldstar.com, and I'm also active on Twitter for those of you who may be more social media savvy. My Twitter handle is @GeorgeCorrali. Thanks so much for listening to today's edition of Market Pulse. We'll see you back here soon.